Welcome to the UAE IFRS Asset Accounting module. This course introduces you to how assets are defined, recognized, and classified under IFRS as applied in the UAE. Beyond definitions, we'll dive into practical journal entries covering asset purchases, depreciation, revaluations, and disposals, so you understand not only the theory, but how to record it in practice. We'll also examine the UAE-specific considerations like fair value, impairment, and disclosure requirements. By the end, you'll be equipped to manage asset accounting in compliance with IFRS and UAE audit expectations. In the UAE, asset accounting follows IFRS to ensure global comparability and compliance. An asset is recognized only when it is expected to provide future economic benefits and can be measured reliably. For example, if a UAE company buys office equipment for 50,000 dirhams, the journal entry is debit assets, credit cash. Later, depreciation schedules, impairment testing, and potential revaluation keep the asset values accurate. This structured approach maintains investor confidence and regulatory compliance. Under IFRS, an asset must be a controlled resource, arise from a past transaction, and have measurable value. For instance, if a UAE firm signs a lease contract, the right-of-use asset is recorded because the company now controls that economic benefit. Contrast this with an unfinalized contract. No asset is recognized yet because control has not transferred. This ensures that only real, measurable items enter financial statements. Non-current assets in the UAE typically include property, plant, equipment, and intangible assets. For example, if a company buys a delivery truck for 200,000 dirham with a 5-year useful life, the entry is debit truck 200,000 dirham, credit cash 200,000 dirham. Each year, depreciation of 40,000 dirham is recorded. Debit depreciation expense, credit accumulated depreciation. If the fair market value later rises to 250,000 dirham, the company may revalue debit asset 50,000 dirham, credit revaluation reserve in equity. These entries ensure financials reflect both cost and fair value. Current assets are those consumed, sold, or converted to cash within 12 months. For instance, when a UAE retailer purchases 100,000 dirhams worth of inventory on credit, the entry is debit inventory 100,000, credit account payable 100,000. When the same inventory is sold for 150,000 dirham cash, two entries are recorded. Debit cash 150,000, credit revenue 150,000, and debit cost of sales 100,000, credit inventory 100,000. These flows show how current assets directly impact both liquidity and profitability. In the UAE, asset values must be kept realistic. For example, a Dubai property purchased at 5 million dirhams may be revalued to 5.5 million dirhams using an independent valuer. Debit asset 500,000, credit revaluation reserve. Equally, impairment must be applied. If falling demand reduces a machine's recoverable value by 40,000 dirham, debit impairment expense, credit accumulated impairment. Useful life must also reflect UAE conditions. For instance, faster depreciation for air conditioning systems in the region's climate. Disclosures are crucial so auditors and investors understand the assumptions behind these numbers. Let's connect theory with practice. Suppose a UAE company buys equipment for 100,000 dirhams. Debit equipment, credit cash. Each year, 20,000 dirhams depreciation is recorded. After 3 years, the equipment is sold for 50,000 dirham. The entry, debit cash, 50,000, debit accumulated depreciation, 60,000, credit equipment, 100,000, credit gain or disposal, 10,000. This full cycle shows how assets move from acquisition through use and adjustment to final disposal. To summarize, assets are recognized only if future benefits are probable and measurable. Classification between current and non-current depends on the 12-month threshold. Non-current assets are depreciated, tested for impairment, and sometimes revalued. Real-life journal entries from purchase to disposal show how theory is applied in practice. With careful disclosure, UAE businesses remain both IFRS compliant and audit ready.